And economists generally distinguish between nominal and real interest rates. The nominal interest rate is the interest rate reported on a typical savings account or mortgage. It tells you how many dollars a saver or a lender will get in the future for giving up a dollar today. The real interest rate adjusts those future dollars for the anticipated rate of price increases. That is, for the anticipated rate of inflation. This means that the real interest rate tells you how much purchasing power a saver or a lender will get in the future for giving up a dollar of purchasing power today. Economists generally believe that households and businesses make savings and investment decisions based on real interest rates over the next 5 to 10 years. So when I was a student back in the 70s and 80s in Professor Blinder's class, the real interest rate was a somewhat mysterious, unobservable object. That's no longer true. Treasury inflation-protected securities, bonds that are colloquially called TIPS, make coupon payments that are indexed to the inflation rate. This indexation means that TIPS coupon payments provide a fixed amount of purchasing power to the bondholder, not a fixed amount of dollars. As a result, TIPS yields provide a useful measure of the real interest rate. When we look at TIPS yields, we see that real interest rates have fallen dramatically over the past 6 years. In the first half of 2007, 5-year TIPS bonds had a real yield of about 2.5%. 10-year TIPS bonds also had a real yield of about 2.5%. Now, jump forward to 2013. The 5-year real TIPS yield is around negative 1.3%. Now, let's just be clear what that means. The purchaser of a 5-year TIPS bond is giving up $100 of purchasing power today in exchange for around $94, that is $6 less of purchasing power in 5 years. Now, even if you go out to 10 years, the 10-year real TIPS yield is also negative, around negative 0.7%. Now, why have real interest rates fallen so much? At one level, the answer is obvious: monetary policy. The FOMC has announced its intention to keep the Fed funds rate near zero until the unemployment rate falls below 6.5%. At the same time, the FOMC has bought over $3 trillion of longer-term assets issued or backed by the government. With inflationary expectations well anchored, that's an important clause, these actions are designed to push downward on real interest rates and have been successful in doing so. But I think this obvious monetary policy answer is actually deeply misleading. Consider the following very Minnesota analogy. Some days during the year when I go outside, I wear a parka. Other days, I wear a light jacket. And this will actually seem hard to believe, and it seems hard to believe now in this longest of winters. On some other days, I don't even need a coat at all. Every morning, I have complete control over what kind of coat I choose to wear. Even more control, than the FOMC has over real interest rates. But of course, in making my choice of outerwear, I'm merely responding to the Minnesota weather, which is a force that is, very sadly, well beyond my control. And I have this italicized in my written document. I don't know how to convey it with this. I don't know how to italicize it in a speech, but I'll say this. The FOMC is exactly the same position of having to respond to strong forces well beyond its control when it's making its decisions about the real interest rate. Thus, when I decide what coat to wear, my goal is to keep myself at a temperature that I view as appropriate, given prevailing conditions that I cannot influence. Similarly, when the FOMC decides on the level of the real interest rate, its goal is to keep the macroeconomy at an appropriate temperature, given prevailing conditions that it cannot influence. More concretely, the committee is taking actions to adjust real interest rates so as to fulfill its congressional dual mandate of promoting price stability and promoting maximum employment. So, for example, suppose the economy is running too cold in the sense that inflation is below the committee's 2% target and unemployment is elevated. Then the FOMC can, metaphorically, put on a heavier coat, that is, lower the real interest rate to stimulate spending and stimulate economic activity. If we go back to 2007, the FOMC had on about the right kind of coat in the sense that its macroeconomic outlook was broadly consistent with the committee's objectives. The fall in TIPS yields over the past 6 years suggests that the FOMC has, in the language of my metaphor, put on a warmer coat by pushing down on real interest rates. Indeed, there are some observers who have expressed the concern that the committee has in fact put on too heavy a parka, given the conditions. But the truth is that the FOMC's choice of winter garb is actually insufficient to keep the U.S. economy appropriately warm. After all, the outlook for both employment and prices is too low relative to the FOMC's goals. Unemployment is currently 7.6% and is expected to fall only slowly. At the same time, inflation pressures are muted. Both private sector forecasters and the FOMC expect that personal consumption expenditure inflation, PCE inflation, will be at or below 2% through the next 2 years. The committee needs to put on some more serious winter gear if it is to get the economy back to the right temperature. More prosaically, the FOMC can only achieve its dual mandate objectives by lowering the real interest rate even further below its 2007 level.